Hey everyone, hope you're doing well today. Hot sauce coming at you. This is one of the most vulnerable, serious videos that I've ever done. I've talked about in my past videos I was going to do this, and I'm here to share it. If crypto goes sideways for the next 6 months or so, what are you doing with your capital, ladies and gentlemen? Well, everyone waits for the next XRP pump and catalyst. I've been generating income in my stock portfolio using this covered call strategy that I promised I wanted to share with you. Today's the day. It's a lot of information. I'm going to show you my real trades, the real premium that I have collected since July of 2025, and exactly how this works. It's taken me my entire adult life to dial this strategy in. We can make it simple. There are some complications. You got to understand some terms and everything like that, but I'm going to try to make it straightforward and give you the information right here. In crypto, we wait for catalysts and things to happen. In options, I sell time. Now, before I jump in here, I want to say something clearly, everybody. This strategy looks simple. It took me a lot of years of real trades, paper trading when I was young, because I didn't have, there's a barrier to entry. I didn't have enough cash to do this technique early on, because you have to own 100 shares of a stock that sells options, that has an options chain. These are real trades, real wins, and real losses, okay, to fully dial it in. Today, I actually don't have any losses on the agenda, but you can't win 100% of the time. We can talk about that here in a sec. If you've never traded options before, pause this video as I move along. Rewind some of the sections. Okay, take notes. This isn't gambling. This is slow and steady, safe investing. This is a structured income model. Let's define the basics real quick. A call option is a contract that gives the buyer the right but not the obligation to purchase a stock at a specific price, called the strike price, before a specific expiration date. Okay, there's an expiration date on it. 3 definitions here. A strike price is the agreed sale price. Expiration date is when the contract ends. Premium is the cash paid up front. When someone buys a call option from me, they're paying me a premium for the right to potentially buy my shares. A covered call is when you sell a call option while owning at least 100 shares of the underlying stock. Important, 3 more bullet points here. One options contract equals 100 shares of the stock. You must own 100 shares per one contract. It's called covered because you already own the shares. Okay, if the stock goes above the strike price, I can deliver the stocks to the person who bought that option. That's why it's called covered. So let's talk about why this works in down markets, in uncertain markets. Okay, like I said, this is my safest strategy that I use. If the stock stays below the strike price, the option expires worthless, and I keep the premium. If the stock goes above the strike price, I still keep the premium, and I am forced to sell the shares at the strike price. So it's very important that you choose a strike price that is a little bit above what you bought the stock for. Okay, the downside here is you're capped off. You can lose upside potential. When I first started this trading, I didn't care. I just wanted to bring in, and I learned this from a cab driver, actually. Gosh, but way back in the day, a long time ago, Wade Cook was his name, and he wrote a book on covered calls. He was a cab driver, and instead of accepting the long rides from city to city that seemed attractive, he would take the little rides. I forget what he called it, but it was the kind of thing where it's like, nope, 2 blocks here, 2 blocks there, 3 blocks this way. But he would just do this. The meter would just cha-ching, 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 little pieces, and that's kind of how that got my attention. I liked his idea on that. So if the stock explodes up, I don't participate above my strike. Okay, there's a cap strike price. You can't make money if the stock goes above that. You can make money, but you can't make the extra money if it explodes upward. So you got to be, the stocks that you choose is another important thing as well. So let's go back to, in crypto, we rely on explosive upside, which is fun and exciting, everybody, right? In covered calls, we monetize patience. You can make money on a down market with covered calls, or the best is when it's just moving sideways, boring, and not doing anything. That's my favorite, when the market is moving sideways. So let's look at a live walkthrough of an options chain. This is my Schwab account. Okay, I'm going to show you guys this. Just want to make sure you can see everything that I'm showing you here. Okay, here's how it works. The stock I'm sharing with you today, it's NVTS is a ticker. Navitas Semiconductors. It's on the NASDAQ. It's currently trading at $7.87. Just to let you guys know, I bought this stock back in July for $8.34. So right now the stock is trading below what I bought it for in July 2025. So if I would have just held and sat on this stock, I'm down over, 45 cents or so. Here's a real live options chain. You come over here, you got a couple buttons if you have a Schwab account. Every account looks a little bit different, but options chains are the same once you get into the options chain. I click options right here. I go down, and there are strike prices right down the middle. What I have to do first is look on the left to see how many days out that I want to look at some prices. Now this is personal. Here once again, what I do is I look around 20 to 30 days out is my sweet spot that I like to do here. And this is active trading. This is an active strategy. You can't just sit back and relax the whole time, but you can wait it out, whatever the strike price, or I'm sorry, the expiration date is. So for this example, let's look at 27 days out. The strike price is down the middle. Now you want to pick a strike price that is not below the entry price of your stock. Like I said, I bought this stock at $8.34. We're below that right now, so I'm going to look for a strike price that is above that. Okay, in this example, they do have, sometimes there's 850s, but now it's just $1 spreads here. $9 strike price is, I would not sell anything less than $9 on this one. Now, there's a bid and an ask. This is the spread that this exchange creates to where they get the in between. It's basically a commission, premium, whatever you call it. I always choose the bid, but you don't have to. If you want to wait until you can sell the option at 58 cents, that's fine and dandy. But I always choose the bid because I know it's going to get filled. So I'm going to click that. I own 400 shares of Navitas. So what I do, I'm gonna scoot myself out of the way so you can see over here. 52 cents is a little bit low. I would want to wait for this stock to climb up a little closer to 834 so the premiums are a little bit juicier. 52 cents isn't crazy, but you can collect premium. So when I come over here, real quick, I have 4. See where my cursor is here? I'm going to put 4 contracts because I own 400 shares. 3, 4. I can collect $208 to sell 4 contracts that will expire on March 20th, 2026. Now, if I sell this option, I can take that $200, withdraw it, it's cash in my pocket. Okay? Now, let's go back over to... Okay, people, thanks for staying with me. Here are my real trades starting on February 9th, and I'm going to work backwards. You're gonna like this. On February 9th, 2026, the stock was trading, again, it's NVTS, at $8.86. My entry price was $8.34, so I had a little bit of upside. I figured I had some previous contracts that expired. I'm going to sell 4 more covered call contracts. You don't have to sell all 4. You can sell 2 contracts, you can sell 3 contracts, you can sell 1 contract. I am choosing, this is personal, to sell 4. Now, when I sold these 4 contracts, by the way, it cost me $3,484.50 to buy 400 shares of NVTS back in July. Okay, that's the barrier to entry I was talking about. My goal personally, these options are, I look for around a $15 down to $3 or $4 strong companies that I can afford to buy 100 shares. Now, the thing is, my goal is to get into building my portfolio to where I can spend $30,000 to $50,000 on each one of these plays. That's my personal goal, and I'm heading in the right direction. But for now, I'm starting with $3,000 to $6,000 is my comfortable range on each one of these positions. This particular example, I spent $3,045.50, and I sold 4 contracts. I got on that options change that I just showed you, and I saw that the $8.50 strike price right here had a premium of $1.27. Anything over $1.27 I like. I mean, anything over $1, I really like that. Anywhere from like 90 cents to over $1 is a sweet spot for me. This was a good premium because it's been a volatile stock. It's been below my entry price. It's been up and everything. So this is a good opportunity. I sold 4 shares and brought in $505.35. This is the premium that I keep. I can put in my pocket, withdraw it, go buy groceries with it, buy gas, whatever you want to do with it. You can pull that out of your account if it's an individual trading account. Okay, there's different things. If you're inside an IRA or a retirement account, that's a different story. Don't worry about it right now, though. Look at this percentage. This is the main thing I want to show you, ladies and gentlemen. When you put up this amount of money, 3,484, you go 505.35 divided by 3,484.50, you come up with 14.5% in 27 days on this one. You crazy? This one is going to expire on March 6th. If this stock price isn't above $8.50, I keep the $500, 505, and we move on. If it goes above that, I am forced to sell the $8.50 strike price. Guess what? I make another, what's 34 cents to 50? Look, I make another 20 cents or so times 400, and then I go on to my next trade. I get called out. You know what? The stock could come back down. I like the premiums on this stock, so I might buy back in when it's below a certain price and do this all over again. That's an example of selling a covered call. quick side note that I don't have on my notes right here. I always look for a delta of around 30. Okay. On that options change, you can go in here and you can find the Greeks, the delta. I look for a delta around 30. Take a note of that. So when you're on options chain, they all look a little bit different. Try to find. That means you have a 30% chance of getting called out. That's not a high chance, but guess what? The premium is fat enough to where a lower percentage delta gives you a little fatter premium. I'm okay with getting a 30% chance of getting called out. That's part of my equation. Here's the fun part, ladies and gentlemen. Here's the fun part that I've been waiting for. I'm going to zoom out here. Since July, I've sold 6 covered calls on NVTS without getting called out. Here's the breakdown. It just generally here, every premium that I collect, it lowers my effective cost basis. That's the thing that attracted me to this strategy. I still own the shares and generate income on top of them. Remember, I told you I bought this stock at $8.34 back in July, and it's trading at $7.87. If I would just sat on this thing, I'm at a loss at this moment. Look how much premium I have brought in since that time. Ba-boom. These are the same trades with the date here over here on the left. So on 1/16, the stock was trading at $9.12. Same barrier to entry price right here. Oh, it went down because I only sold 3 option contracts. On this example here, I only sold 3. I wanted to hold on to 1 because I heard some positive news that this thing might take off. I still wanted to keep my 100 shares. If it did, $10 strike price. I brought in a little bit less, $178. That's fine. Remember what I was talking about? Chi-ching. We're just bringing in a little bit of cash. That turned out to be a 7% gain on my money. And this one was roughly, it was a 27-day. Backing up to January 9th. The stock was up at $10.15. I almost sold, but here's the nice thing about these call options. When you have a big run up like that, instead of just selling your stock outright, why not just sell some call options and absorb and bring in some of that run up? That way, if it rolls over and come back down, you're protected on the downside by $341 right here. This price could go down $341 and I'm still breaking even. So on this example, I brought in 10.2%, selling 4 shares of the 1050 call option. Guess what? The stock didn't go up to 1050 on, or February 6th was the date, so I kept it. I bring in the premium and I keep the stock. Backing up. Remember, I'm going backwards here. This is in December 5th. The stock was trading at $9.44. I sold 4 shares. I brought in $335.45. That equated to 10% gain on my money. It's that same $3,336. I rounded it up on that one. Let's keep going. The next one. That was back in October. The stock was trading right about the same price. See, you can do this, people, right when you buy a stock, you can turn around and sell that call option to give you some protection to the downside right away, immediately. That's we were at here. I bought it for $8.34, that same price. It was trading at $8.35. I'm like, you know what? I want some downside protection. I'm going to sell some call options. Sold 4 of them. Brought in $374 that equated to 11.2% gain on my money immediately. You have to wait for the expiration date, so it turns out to be roughly a 25 to 30 day period that I had to wait to see where the stock was trading at on October 31st. Backing up, this is the first This is the first one that I did. Now look at these two columns right here. Stock purchase price was $8.30. I immediately sold 4 call options on that same day that I purchased the stock for the first time, and I gave myself a $360 downside protection, meaning I brought in that much premium that equated to 10.8%. In roughly, so this was from July 23rd. The expiration date was 8/15. So that's less than 30 days. Actually, that's quite a bit less. At a strike price of $9. I did this play immediately. There's no way you can lose. I mean, you can lose if the stock dumps. That's why you got to do your research and pick. I have a list that I've done a lot of research on which options I buy for covered calls specifically. Okay, and again, they have to be from $15 to $5. I did some Neo shares that were trading around $3 or $4. I made a killing on that as well, but I did lose some upside potential because it took off. So I was like, darn, if I would have just held, I would have made more money. But guess what? This is a safe strategy. That's why I'm teaching it here to you guys. In conclusion, on these, what was it, 1, 2, 3, 4, 5, 6 covered call plays, I brought in $2,094.15. My entry price was $3,336. I rounded up. Look at this, people. Can you see that? 62.7% gain on my money since July 23rd, 2025. And I still own 400 shares. Is that amazing? This is, look, the stock market and the NASDAQ is at the all-time highs and everything like this, but it's volatile. It's rolling over. It's going to start dumping down. For me on this, it doesn't matter because I'm going to hold on. I could either sell at a little bit of a loss that will take down my premium just a bit, because like I said, I just showed you it's trading at $7.87, so that'd be 30, 40, 50. So I'd take about 50 cents off the table times 400 and walk away with an over 50% gain on my money in 6 months. I wanted to share you this example with you today. I'm still bullish on XRP, people, for the long term. We are seeing some volatility. I do think it's going to go below $1. But if you got into XRP below $1, it might not be a bad idea to take some profits and put it over into a safer trading instrument such as selling covered calls. That's what I have done. While I wait for this huge cryptocurrency pump, I just don't sit idle. That's what I wanted to share with you today. I'm constantly trying to move money around safely to bring in. In crypto, don't ever sell if you're down, because it's going to recover. We've seen this historically. I'm down in a bunch of business. Everybody's down in crypto. Actually, I am still up a little on XRP. And I'm trying to, I'm perseverating over enough, so I should sell some of my shares to roll them into a covered call safer play or not. That's where I'm at right now. In crypto, we wait. In options, I sell time. That's what this strategy is all about. Now, if you want, I can continue sharing these real trades. I've done hundreds of trades like this. Listen, I've only lost like 2 times out of hundreds of trades on this kind of stuff. So I can share this with you, these real cover call trades monthly, so you can see exactly how this income compounds over time. That's what my goal is here with you all today. I wanted to share that with you. If you would, please give me the thumbs up, everybody. Hit that subscribe. Let me know if you want me to keep showing you these trades. I have tons of them to share with you. This was my most recent one, so I wanted to go back and show you how it's been going since July. I have tons of other though, but Always appreciate y'all. Hope that helps you out. Like I said, stop the video, write some notes, do some examples, go on a simulator account and try to do some of these before you put real money into it. Takes a little bit of understanding and getting used to, but I'm telling you, once it clicks and you start to understand the strategy, it can help you out in the long run. Appreciate y'all. Hopsaw signing off. Thanks for your time, everybody. We'll check in tomorrow, see how things are going in the crypto market. Good stuff ahead. Let's be patient. All right. Peace out. Peace out.